I'm more realistic here, and we take the increase in the level of government debt since we came off the gold standard in 1971, and we mustn't forget the reason we came off the gold standard was because the level of debt was already way too high compared with the gold in stock. But if we just take that number, that very high number, and look at where it is today, we should be at a gold price of about 5,500, well, going on 6,000 now. So do I think we're going to go there? I think we're going to go there. I think we'll go beyond. Of course, we don't know the future of the gold price, but I personally think that it will go higher for a number of reasons.
According to a report released on Friday by the Congressional Budget Office, the United States is set to accumulate trillions of dollars in additional national debt over the next decade, driven by the rising costs of social safety net programs and increasing interest expenses. The new budget forecasts indicate a $1.9 trillion budget deficit for this fiscal year, with annual deficits over the next decade totaling $21.1 trillion. This will add to a national debt that already exceeds $36 trillion. As the global economy faces an escalating debt crisis, renowned precious metals expert Clive Thompson has sounded the alarm on potential economic turbulence. In a recent interview, Thompson emphasized gold's enduring role as a dependable store of value during periods of economic uncertainty and rising inflation. He pointed out that government debt levels have surged dramatically since the U.S. abandoned the gold standard in 1971. According to Thompson, if the increase in government debt were measured against current gold reserves, the price of gold should already be $5,500 to $6,000 per ounce. Consumer prices for a range of goods and services rose again in December, but there was some mildly positive news on inflation as the year ended, particularly in the housing sector. The Consumer Price Index saw a seasonally adjusted increase of 0.4% for the month, bringing the 12-month inflation rate to 2.9%. Finally, Clive Thompson argued that the rising prices of specific goods and services, such as luxury vacations and rare collectibles, are driven not only by the cash supply, but also by the accumulation of wealth fueled by government borrowing. He expressed his belief that gold prices will continue to rise for several compelling reasons, underscoring his strong confidence in gold's long-term value as both a hedge against inflation and a mirror of the growing global debt crisis. We're about to explore the video, but first, make sure to subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
So that was my first exposure to gold. But as the years went by, I came to realize one of the reasons why the gold price was going up was that the money was going down. And that's all to do with the amount of money. And I was living in Britain for a while and then overseas on the US dollar, actually. It's all to do with the amount of money being printed by the central banks. At the time, you didn't really know where this was coming from, but you could see the inflation rate. The price of houses were going up. The price of food was going up. Salaries going up. And, when I started work, we're not talking about the sort of mediocre 5% pay rises you're getting these days. Inflation at one point in the UK was running at 30-odd%. So we were getting really hefty pay rises. And, you could take your pay rise along to the bank and or along to the gold dealer and buy yourself a nice coin, and knowing almost with certainty that in a few years it was going to be worth a lot more.
Where do you see where we at now and where are we going?
Well, a little bit earlier, I talked about the printing of money that we saw in the 1970s, 80s, and obviously ongoing even today. And obviously, that was driving the retail price index, the consumer price index, wages, the price of food, and price of everything else. But and I think a lot of people have become very fixated on the relationship between money supply and prices. But I've come to realize in recent years it goes much, much deeper than that, because we have on the planet a sort of money which wasn't really looked at as much in the past, and that's the huge level of government debt, which is massively exceeding the money supply. And don't forget, all of this government debt is a promise to print money down the line at some point in the future. But to all intents and purposes, it is money, because you and I can take my treasury bills, my treasury bonds, sell them instantly and turn it into cash. not like the old days where you buy a bond from the post office, then you keep it to maturity 20 years later, and then you get your cash back. These days, the government debt is as good as money. It's no different from putting your money into a money market fund or a CD. It just happens to have a little bit longer maturity, but the day you want it back, you can get it back instantly. So what's going on in the world, and why do we have to look at government debt in addition to the money supply, which actually in some countries, the money supply isn't increasing that fast, but the government debt is. So what's going on here? When the government wants to spend more money than it's got, it borrows the difference. That's called a budget deficit. When it borrows money, the government gets poorer and someone else gets richer. So the government has been going deeper and deeper into debt forever, more or less. I mean, there were times in very, very distant past when they ran surpluses, but those days are gone. So the governments are going deeper and deeper into debt, and someone else, as they go deeper into debt, gets richer because they're spending that money. Now, that money which is being spent might be deployed by the wealth gatherers. These are the wealthy people. Could be somebody with a good job, or somebody in retirement, or it could be an entrepreneur. But the wealth gatherers of this world, those who are not living hand to mouth, are accumulating the wealth. And what are they doing with it? Of course, they're buying treasury bills, and they're putting money on CDs and so forth. But also, they are spending money on the kinds of things that wealthy people want to own, whether it be yachts, nice houses with a nice posh drive, paintings on the wall. I've got a few paintings behind me which I paid a couple of $100s for, and suddenly I'm not just talking about the extremely wealthy. I'm talking about anybody who gets to his retirement age and just has a comfortable life. He wants to be able to go on holiday. Well, holidays are in limited supply, so the prices of holidays will be rising not by the increase in the amount of cash on the planet, but by the increase in the amount of wealth, which is better defined in particular by the amount of debt being created by the government, because that's what's being distributed.
Driven by factors like robust global gold exchange traded fund, ETF inflows, and increased over-the-counter OTC demand, gold had a record-breaking year in 2024, with its price rising more than 28% in US dollars. On average, the price was 22% higher compared to 2023, according to the World Gold Council's WGC Gold Outlook 2025. The performance of precious metals was equally impressive across other currencies, with the WGC reporting that gold reached 40 new record highs throughout the year. Additionally, total gold demand in the third quarter of 2024 surpassed $100 billion for the first time. Clive Thompson observed a notable rise in central bank gold purchases, marking a significant shift in the market. He expects this trend to accelerate as nations continue to issue debt, with some of those funds likely allocated toward gold acquisitions. Thompson highlighted that central banks are becoming increasingly cautious about holding substantial amounts of U.S. Treasury bonds, driving their renewed interest in diversifying reserves with gold. Now let's redirect our attention to a video.
We're starting to see an increased level of central bank buying. You may recollect that, I think it was the 80s, under the guidance or instructions of the IMF, many central banks, not the United States, but many central banks were effectively ordered and agreed to start selling off their gold. So every year we'd have these gold auctions as the central banks got together and auctioned off their gold, and they had less and less of it. And then there came a point where the central banks started saying, we're not going to do it anymore. We think we've sold enough. And that's when the price took off. We've gone from a sort of stable situation, going back a few years now, to a situation where some central banks, Poland, China, for example, are back in the market and acquiring gold. And why are they doing that? It's because the level of their foreign exchange reserves has risen a lot over the decades, but their exposure to gold, at least in terms of ounces, has been fairly static. But now the level of foreign exchange reserves which is mostly dollars and dollar treasury bills, means that their gold reserves are perhaps no more than 2 or 3% of their total reserves. So central banks have started to buy those who don't have much are starting to buy gold to improve their exposure to gold and reduce their exposure to the dollar. Buying by central banks is set to now start to increase. Central banks are completely insensitive to what the price of the gold is when they buy it, because after all, for the most part, they can print money at any time they at ease if they want to and buy gold. They're not going to do that necessarily because that would devalue the currency and be a bit too visible. But we've seen that happening. We see it happening because countries around the world are issuing debt. And what are they doing with the debt? Well, some of it can be used to buy gold. And I think that's what's going to happen. The other reason they're buying gold, I think, is a general level of worry about the treasuries, because most of them hold US treasuries. Of course, they hold bonds issued by the European Central Bank and European governments and the UK as well, but it's mostly US paper.
Yeah.
We have a situation, and we've had it for many years, where nothing is being done to address the rising budget deficits. So the level of debt is rising now faster than at any time in all of history, with the one exception of the COVID year or year two, when it did rise very, very rapidly. But we're certainly way beyond pre-COVID levels, big time. And if you look at the USA, we've got the figures from the Congressional Budget Office, CBO, which shows that according to their own numbers, the level of debt is set to rise at a faster pace than the economy. In other words, that's called the debt to GDP ratio. So the debt to GDP, gross domestic product, the debt is going to rise faster than the gross domestic product. So put that in perspective. If you were an individual in the same situation, it would mean that your credit card debt is increasing, let's say, by 20% a year, but your salary is only going up by 3% a year. Now, the figures aren't quite as extreme as that.
Gold's outstanding performance in 2024 delivered its strongest annual gain in 14 years, surpassed only by its remarkable run in 2007 over the past 25 years. Global central banks have increasingly turned to gold bullion for reserve management, influenced by factors that have grown more prominent since 2022. Between April 2022 and the close of 2024, gold bullion ETF holdings declined by 22%, yet the spot gold price surged by an impressive 36%. Do you believe gold will continue to serve as a reliable hedge against inflation in an era of shifting monetary policies? Join the conversation. Share your thoughts in the comments. Give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.